All right, so we should probably kick this off then. Welcome to the North American Carbon Market Forecast panel. My name is Mike Szabo. I am a correspondent and co-founder of Carbon Pulse. So we are basically a trade mag for carbon markets worldwide, as well as other carbon pricing initiatives, carbon taxes, and just wider climate change policy. And so on the panel today, we have Chris Bush, who is Director of Research at Energy Innovation, Jackie Cooley, Carbon Market Analyst at ICIS. I have to remember to use that,
Thank you.
spell out the acronym.
We appreciate that.
Just in case any CIA barge in here. Sean Carney, President of Finite Carbon, down at the end, and Andre Templeton, founder and principal of Alpha Inception. So basically, we're just going to there's quite a bit to cover, so we'll possibly be jumping around a bit, just because the point of this session is to look at what the markets will look like in the future across North America. I'm not sure we'll get to every market, but we'll try to cover the main ones, and then what players and influences may impact the development of these markets. So. Obviously, you can't really look forward without looking back and understanding where we've been. So I wanted to first touch on the auctions, and maybe get Andre to kick things off and just give us a quick summary of the recent auctions in WCI in Ontario.
Sure. So starting with California, obviously, over the last year, and everybody's been living through it, we've had a number of auctions that have not sold the full volume. I think we actually haven't sold full volume for 5 auctions now. So decent period of time. Most of it is frankly driven by the oversupply, which has been building up and which most of us have sort of seen coming. But I think a lot of it was really the oversupply compounded by the loss of confidence and really to some extent, you could see this last year with the surprise Supreme Court decision, a view that there was enough things out there that were scary with Reggie coming down and big losses in the Reggie market. You had a de-risking of a lot of the California portfolios. And once you drop below the floor, I think there was a view that, quite a few risk groups had probably been told that you could never go below the floor. And then once we dropped below the floor, we dropped quite a bit below the floor, and everybody, I'm guessing, had some interesting discussions with their risk groups as they had to explain why we dropped below the floor and how it happened. We saw a significant amount of volume move from what I would call speculative or specu-hedge type entities into compliance entities' hands last year. Probably about 50 or 60 million tons in California shifted from people who'd been sort of risk capital to people who were viewing this as an alternative to the auctions. And with that and that loss of confidence and hovering around the floor, it was very natural that the auctions would not succeed because you could buy at or below or close to the floor in the secondary market, and you can continue to do that until very recently. So California was quite reasonable, quite expected. We and many others had predicted that those auctions would end up that way. And so they weren't a surprise to people who were sort of watching. Now, a lot of people were surprised, but they tended to be people who were not paying attention to all of the details and what was going on in the market. Ontario, interestingly, and the last auction just happened. Actually, before I jump to Ontario, just really quick, November we saw a big pickup, and it was kind of a little bit of a head fake because a lot of people sort of assumed that meant that things had been fixed. Now, they hadn't. It was just a technical reality of the last auction prior to a price increase. And so we saw a lot of forward buying for demand for this year. And so we expected the February auction to be very, very weak, which it was. And again, so that was very technical, very expected, and continues that way. Going forward, I think, I'll talk about California first, and then I'll quickly talk about Ontario. We'd expect that with secondary market prices where they're at, auctions should start to look better later on this year, but it's going to depend a lot on how much certainty we get out of the legislative front. Now that the governor's sort of put that stake in the ground and said, look, I want a 2/3 extension, he's raised the stakes, and the likelihood of a 2/3 bill but he's also raised the risk of failure. And so I think everybody's watching that, and to the extent that that looks good or bad going into the May and the August auction, you could see those auctions either be quite a bit more successful or also be sort of a little bit of a swing and miss if things come out that make that extension look at risk. Ontario, the volume cleared for the current vintage made a lot of sense again, because Ontario right now is not linked, and Ontario entities, our forecasts, and Jackie, yours probably shows the same, the Ontario market is quite short. And so in a pre-linked market, not knowing for sure if the linkage is going through, it's just prudent for Ontario entities to buy in their system. And so we saw a full sellout of Ontario, and that made a lot of sense. Interestingly, what you might see in Ontario going forward, which should be kind of interesting, is depending on what happens in California, if linkage seems very secure towards the latter half of the year, and the California auctions are not doing very well, then the Ontario auctions may regress down to a lot less volume as people start to look at hedging in the secondary market and not having to go to the Ontario auctions. So Ontario could be kind of a slightly different pattern than California.
We could see some cross-contamination there.
Yes.
Okay. Now, just turning to Jackie, maybe talk about how the behavioral changes that we've seen has led to these undersubscribed auctions and how that might impact future auctions.
Yeah, sure. So I think Andre said it well, and probably as most of you know, in February of last year, the Reggie price crashed from $8 to $4, following the legal stay of the Clean Power Plan. And so since there are a number of cross-listed companies, a number of active traders in both markets who experienced significant losses, a lot were forced to sell off their positions in California as well, and just generally to reassess risk. I would say around the same time, so at the beginning of the year, I'm not sure the exact date, but the court also granted expedited scheduling of the Chamber of Commerce case, and so people kind of started to look back to what was going on there and assess their risk differently there as well. The downside risk, they canceled the floor price. The price drops potentially, $5, $7, $10, whatever it might be, to an upside risk where the ARB wins and the price jumps like we did, but like we've seen. So essentially, people were changing their behavior a bit there. They weren't in as big of a rush to start buying allowances. As Andre also mentioned, that there is some significant oversupply in the market heading into 2016. We estimate roughly around 100 million or so, maybe a bit more. So there was the opportunity there for entities to kind of, take a wait and see policy, to kind of sit back and kind of wait it out, and then for the result that we got here. So that was a pretty big behavioral change in the market, that is minimized by this result that we just got a couple weeks ago.
Okay. And looking forward, I know, Chris, you've done a lot of analysis kind of predicting how the sales are going to perform through 2020. Do you want to just take us through a bit of that?
Yeah. Well, I did not a price forecast, but just looking at sort of a balance of supply and demand for the market and doing some really pretty simple forecasting, taking just the emission trend over the 3 years we have data for, extending that forward, looking at the compliance instrument reports to see how much has been retired already versus still to come into the market versus what's held, and based on emissions versus supply, it seems like emissions would be about 240 million metric tons below cap levels. So in terms of what that means for prices, I think this risk capital and the question of the longer-term certainty for the market will affect, the extent to which that is held back by the price floor versus rolls back in. And I think there's a lot of timing questions, and maybe we can get into some of those uncertainties. But can I just ask Andre, because I was glad to hear that he put, market fundamentals as important factors. I was in one side event yesterday where they were sort of market sentiment was put above everything. So as someone who's not a trader, talking to people day to day, I'm glad to know that sort of the fundamentals matter. But I'd be curious, because it sounds like you're a a little more pessimistic maybe about the next year, because looking at the 2017 numbers, you know, something someone just pointed out to me yesterday, that the 2018 vintage that sort of people have banked from prior advanced auctions, it looks like there's about 50 or 60 million kind of from 2018, 2019 that won't be usable, and that maybe 2017 is a little tighter than than it sounds like you're thinking, based on what's going to be needed.
Yeah, I mean, you know, the important thing to remember in this market for compliance entities is that because you've got delayed sort of compliance, right? So, you know, entities only need a certain amount, and because we did have that surplus, you know, back to your question on the fundamentals, sentiment's important, but the only reason sentiment took over is because there was enough surplus out there for sentiment to be able to happen. If we'd been tight and 50 million short, I mean, sentiment would not have brought us below the floor, because you in essence couldn't have gotten below the floor. But the fact that we had that surplus and then that negative sentiment, and then, you know, to your point, Reggie, I mean, people lost, by our estimates, $300 million. So it wasn't like a little small amount of money. So $300 million in about 4 days.
Yeah.
So that was a significant loss to portfolios that they had to make up somewhere. And the way I describe it to people is, if you get a margin call on one of your stocks, you're gonna have to sell the other stock. So they got margin calls, and it's not technically exactly what happened, but in essence, you lose $300 million in Reggie, you're gonna have to sell something else.
Yeah.
So the sentiment only happened because we had the surplus. If we'd had a tight market, it wouldn't have happened. You know, you do run into an issue sometime next year, when we start to have to turn in the triannual compliance obligation, that you've got about 140 million tons that has not sold in both 16 and 17. And based on the numbers that Jackie just said, where you're maybe 100 million tons oversupplied, you know, you might have a technical short. So it could happen. But it really depends on final emission numbers, you know, what else gets released. Bear in mind, if you've got successful auctions towards the end of this year, then under the current mechanism, assuming it's not changed, ARB would start releasing 17 volumes into the market next year. And so that could, you know, make sure that you're actually oversupplied 17 again. So there are some scenarios where it could be short, but it's probably not likely.
Okay. So just to ensure that the audience hasn't fallen asleep post lunch, based on what you've seen, could I get a quick show of hands from the people who think that the next few auctions will be undersubscribed? It's just a quick straw poll. It's very unscientific. So this is unsubscribed. Okay. Yeah, sorry, undersubscribed. And then oversubscribed or selling out. So it looks like the undersubscribes have the lead there. So okay, let's move on to kind of wider market issues. Again, with Andre, I know you were keen to talk about some of the challenges that players see, or participants are seeing with the way that the market's constructed, and you know, whether they're speculators or compliance players. So if you want to maybe talk us through those.
Yeah, I mean, a couple of issues. Number one, I think the most important market issue this year is really going to be what happens in Sacramento, which is why I'm there every 2 weeks. Because the reality of this market is going to be, do we extend it? If we don't extend it, you know, the governor's put his political capital behind extending it. If that fails, I think the market's going to view that as a very significant failure. As we talked about in the last panel, it's very likely the Supreme Court is going to take up the appeal. And so if you have a failure at the legislature and of the governor to extend the program, and you have a lawsuit now pending again for another 2 years, it really makes it very difficult for risk capital to come back into this market. And in fact, right now there's very little risk capital. I would probably argue that what's left might actually leave if we don't extend the program. So I think what happens in Sacramento is incredibly important for this program. And I think it's incredibly important for the confidence, because if you don't extend it again, then I think the prudent behavior of a lot of entities is they're going to only buy what they need to buy for compliance. And not only for what they need to buy for now, but only what they need to turn in, which is even less. And so you get a shift in dynamic and hedging behavior that makes the market a lot more pessimistic if they can't sort of succeed on these things. I think the other thing that's going to be really important is, while the governor has so far viewed it as, well, we just need to extend it beyond 2020 and have a 2/3 vote, the legislature's made it very clear that the first time in AB 32 that they were very general and sort of left everything to ARB to decide, and they've made it very clear this time that they want to be very prescriptive. So if you look at 378, if you look at 151, if you look at the discussions going on, it's about essentially whatever legislation passes being incredibly prescriptive. It might end up being a 20, 30-page bill by the time you're done that tells ARB exactly what they want to do on a number of issues: price caps, speed bumps, price escalation. So you could have a lot of redesigns to this market in the next 3 or 4 months that are going to have a big impact on the fundamentals. So that 3 or 4 month regulatory / legislative window is as important, because it's going to shift our supply demand all around.
Mm-hmm.
Yeah, and if I can, I'd go back to the point on behavior that Andre is making. So something that we include in our analysis is behavior, and that companies are acting proactively in this market ahead of market shortage and hedging their risks there. So, I mean, something that you can't necessarily do if you've got a hard stop on December 31st, 2020, and you're looking at least over a 3-year investment period. As soon as you roll into 2018, I mean, you don't have advanced auctions anymore. So that's something we've seen in 2017 and 2016 is less buying in the advanced auctions. And I think that's largely a result of the lack of legislative activity on this, or their ability to kind of push it through, which is why it's particularly important in 2017, because you're past that 3-year horizon as soon as you hit January 1st, 2018.
Yeah.
Right, and yeah, I guess it's all well and good to extend it, but if you're extending a market that's massively long, then it presents new challenges. But I guess, Chris, you were...
Well, I just was going to offer an optimistic hope. I think I agree. I agree that what happens in Sacramento is sort of fundamental and was going to drive sort of outcomes. And just a point to remember that the governor has said, the post-2020 questions are really driven by Prop 26, and it only passed by 52.5% of the vote. So we're trying to assemble this 2/3 majority based on a vote that wasn't nearly as high a margin. So, and the governor has $15 million in his campaign left over from his last campaign that he said he's going to put into a ballot measure to take this to take this to a vote in 2018 if he has to. So to me, that's an optimistic backstop that won't solve any short-term problems, but in terms of the long run, I think we'll get there one way or the other.
Well, I'd actually, Chris and I suggested we should argue on everything, so I would disagree strongly. And the reason I would say that is, look, when the governor put down, and I would say that to anybody in the room who can affect the governor or suggest things to him, is that I think it was great that he stepped out and put this in his budget in January, and that he said that it was important to give certainty and to get the 2/3. But the minute he did that, perception became reality. If he fails this year and we can't get it passed, we may see the end of the program. Because the reality is, I guarantee you, some of the EJs, some of the people out there who don't like this thing, if you can't get it passed this year in the legislature, next year, before the governor puts on the ballot measure, the discussion will be, what should we replace it with? Cap and tax? All those discussions that we've wanted to go away will come back roaring to the forefront. And remember, again, next year the governor's a lame duck. Sadly, he's finished. He's not going to have the ability to sort of use that leverage. So his strength in getting this bill done is this year. And if it fails, I mean, I'm kind of afraid that cap and trade's got a window that's done if we can't get it done this year. So those 4 months are crucial, because a failure, in my opinion, would be potentially the end of cap and trade.
Yeah. Well, Brown this morning said that, I guess most of us were in that session, but it sounded like he was really going to give this his all over the next few weeks. So
I hope so.
Fingers crossed. Right. So we've highlighted that as one of the major risks facing this market. But if you look elsewhere in California and then abroad to Ontario, there are other risks that are kind of peeking through. So one of them is the California court case, which now we know is being appealed. And then you've got the Ontario election. So on the day of the first Ontario auction, you had the leader of the opposition, who's ahead in the polls ahead of next year's election, come out and say, right, this market's gone if I win, which was, you had some columnists liken that to sabotaging the whole thing. So there's that. There are other unknowns. So who, Andre, do you want to?
Can't talk.
Unless anyone else wants to talk
I'll
about this.
spend 2 minutes on it. I guess, I mean, again, back to the importance of the legislation is it's probably very likely the Supreme Court will take this up. So without legislation to put this issue to bed, we're going to have another 2 years of uncertainty in California. That's horrible. The Ontario election is a big issue. I mean, if the linkage occurs before, we're probably fine. I mean, as Mr. Murray said today, it's hard to undo this thing once you've started. And there is a certain amount of that. I think that's probably the only reason, frankly, that the legislature is focusing on cap and trade, is because many of us walked around the legislature and said, if you wanted to switch to a cap and tax, it'd take you 5 years. And so the fact that it's there and quote unquote working gives it a certain amount of sort of staying power. But, you know, if for some reason the linkage hasn't occurred and the progressive conservatives come in, there's absolutely no way they'll allow the linkage to go through. I mean, they will most assuredly kill it. I mean, they're of the view that it's exporting money to California. They would prefer to have some sort of a revenue neutral carbon tax. They don't like it. They view it, they're making it one of their policy objectives. So, you know.
But then I guess when it's one thing to, as we've seen obviously in the past 12 months, it's one thing to say certain things on the campaign trail, and it's another thing to actually execute those pledges in office. And so, I mean, this is, I guess, for the whole panel, but this is, the Conservatives are kind of the party that are more geared towards the private sector, and if they come in and emitters and other participants say, you know, we've set up this infrastructure, we've set up these compliance teams, everything's in place, don't go and dismantle this.
Well, they'll let it run its course through 2020.
Yeah.
Because they have no choice. Once it's started, you can't stop it. I mean, that's the reality of the compliance mechanism. So it's going through 2020. In my opinion, the question is just, does it link or not? And if it doesn't link, then, you know, one of the things we talked about this morning, which was, I thought, huge, is there is a leadership issue here, right? We want to expand these markets. We want the markets to link. We want to have more of the economy covered by these things. And so if that effort stalls out, that's my phone. If that effort stalls out, I think that's just negative in general. So, you know, my hope would be that we link on January 1st, and the worst the PCs could do is sort of try and reevaluate things for a 2020 date.
Yeah, and there's a process that goes along with delinking. It's not just as simple as Ontario decides they're going to walk out tomorrow.
Cut the cord.
I'm pretty sure under 1018 it's at least a 12-month process, I believe.
Yeah.
So it's not quite as simple as that either.
Yeah. The way I describe it to people is you can get married in Vegas very quickly. Divorce takes 2 years.
Yeah,
So, you know, once we're linked, unlinkage is not something you can do overnight. It's going to take a while.
Yeah. Okay. So I'm keen to get Sean involved as well.
Yes.
So that means offsets. I know there are some risks and some uncertainties on the horizon for that side of the market. I wonder if you can just kind of give us a run through of those.
Yeah, sure. So I think just background on offsets is that they're tiny little piece of this program. I think that we've talked a lot about the allowances and all the dynamics and everything that happens, and you know, it's not possible to lose $300 million in offsets overnight. It doesn't happen. Offsets are 8% of this program, and that's it. So it's a very small piece. I think that the most exciting thing about offsets is that this program is working. Offsets are working. It's actually happening. The fact that a landowner can get paid for adopting new sustainable management practices is no less a miracle than life exists on Earth. I mean, everything has worked almost perfectly. There is no price floor on offsets. You know, there is no price control mechanism whatsoever. It just so happens that offsets are at a price that makes it worthwhile for some landowners to pursue this kind of program. So everything has been perfectly balanced. I've criticize, offsets in general, saying it's a market created by bureaucrats, which means it's destined to fail. But if you've looked at the results so far, what you have when you look at California offsets is, almost 75 million offsets to date, $750 million. It's not too big. We're not oversupplied. This isn't, the price isn't such that, everybody's rushed in. We've filled the market and it's gone to zero. We're tracking on a very good timeline, so it doesn't look like that's going to happen. And there have also been all these calls for, we need more protocols. We don't have enough offsets. Well, we're about halfway there. I mean, we're getting close. It's 2017. We're about halfway through the program, about halfway through on offsets. This is the single largest opportunity for forest conservation in the United States. We have this thing, or used to have this thing called the Forest Legacy Program, which had hundreds of millions of dollars for easements. The carbon offset program is putting more money into the hands of landowners in the United States than any federal program. So it's the largest source of conservation capital in the country. We have over 6 million acres listed under this program for forestry. It's larger than the state of New Jersey. So it's significant, it's real, it's material. But some people, don't like the idea of offsets. They've become kind of a target of this program, and it's hard to say exactly why. What the issues are. One is that they are a very small piece of this program. The allowances are a much bigger part of it, and the revenue from allowances goes to the state of California. The revenue for offsets actually goes directly onto the ground to influence the management practices of landowners to sequester more carbon dioxide and prevent the emission of carbon dioxide. So it's a much more direct connection between the money coming out of the program and going into a useful area. So that's one point I'll make. And the other one is, this isn't a cap and trade program so far. The good news is that the emissions are coming down. We're way ahead of schedule. The emissions reductions are coming because we have a price on carbon, not because we have a cap. So the offsets are where a lot of these, when you look at the amount of actual reductions because of the cap or because of this program, aside from there being a price on carbon, the direct emissions reductions are coming from offsets. So that's the background offsets. Going forward in the future, there have been a lot of potential changes proposed. One of them is that maybe we cut it down from 8% to 4%. Maybe we take it from 8% to 12% on the other side. One issue is that not everybody's using their 8%. Maybe we make it tradable because right now we're only using about 5 to 6% instead of offsets. They're actually being used by utilities and other compliance entities because some are too small. They just don't use offsets at all. So there's a lot being left on the table because of that. So the proposals going forward could limit the ability of offsets to participate in this program, or could change how offsets are used in this program.
So, yeah, I think everyone would agree that they're kind of what offsets have become a bit of a whipping boy for this market. But and so one of the proposals that's out there is this system of tiering offsets, so giving more value to certain types. Is that something that you guys support, or do you have concerns about that?
I would like to see something that works for everyone. So is it good for a market to have lots of tiers to it and make it really complicated? No, it's not. But offsets in general aren't electronically traded. It's all over the counter already. There are different tiers. There are CC08, CC03s, golden CCOs. It's already really complicated. It's never going to be standardized. So would it really impact us all that much? No. Would it be good for people to feel like there's a special carve out for California where emissions reductions happen in their backyard? Sure. And if that makes them happy, that's great. I mean, the one thing I'll say is that getting rid of offsets altogether, if you care about environmental justice and you care about disadvantaged communities, one thing that I think that is very unknown in this entire program is that about 40% of all the money that's come into the offset program so far is going to Indian tribes. So if you were to cut that off from the rest of the country, I mean, you're taking a community that's already inarguably disadvantaged and taking this opportunity away. So if you care about disadvantaged communities at large, that would be one of the biggest hits to that in general. If you care about disadvantaged communities or any community in California, then yeah, that would be beneficial.
Okay.
Can I add something on offsets, I guess?
You may.
Thank you.
Me too.
So, you brought up the number, $750 million. One of while that is going to projects on the ground, it also means it's not going to the California government. Have there been thoughts? I know one of the thoughts that I've heard sort of bandied about out there is that offset projects would pay sort of a dividend back to California or a dividend to the jurisdictions to sort of equalize the fact that the money is generally not going into the state coffers. Is that something that offsets could support economically if it wasn't extreme?
Yeah, the answer is no. So here's the thing about an offset. You look at a price. There's what we call a golden offset. That's say $11.50. Then you have a CCO 8. Something with 8 years invalidation on it. Price for that is $10.25. So right there you have $1.25 that is purely because of this whole invalidation thing that somebody in California just made up one day, taken off the top. Then you look at $10.25. Well, finite carbon, we get paid as a percentage of the offsets. The more complicated this program becomes, and it gets more complicated every day. There are fewer people that compete, fewer developers that compete to create these, which means that there's less supply of people to develop the projects, which means that the projects have to be bigger for one, and for two, our margins have to be there. So then take another 20% off of that. So then you're looking at the landowners on the ground are actually only getting $8 a ton. So you're already taking off 35% of all the revenue out there just to get it from the forest owner to the market. So everybody's scraping it off already as you go. So the state of California wants a piece of that as well. They'd be better off adjusting things to ensure that the program is, if they want to make it more economically sustainable to get some money back, scale back the invalidation. At least make it a little bit more certain. That way the invalidation discount is smaller. Make it a little bit easier to comply so we get some more competition among developers so that the margin that we have to take is lower. Then more money actually ends up on the ground. And then if the state of California wants a dividend out of that, then there's some more room for it. If we scale it back any more, you're going to hit this point. Forestry is not, there's another place for wood to go. You cut down trees and you sell it. We're telling people, don't cut down trees and you'll get paid. Well, there's a trade-off. There's an economic trade-off, and that's changing dramatically now because new housing starts, possibly higher inflation. The economics of the timber carbon trade-off are changing as we speak right now, which is going to limit the supply of offsets.
Okay.
It reminds me of, so I've been covering this, carbon market since 2007, and so, and that includes the CDM, which was the original offset market under Kyoto. And so one of the things they introduced later on was to appease some critics and alleviate some concerns was they had an adaptation fund where the 2% of the revenues raised by offset sales went to this fund to fund adaptation projects. If it came down to something like that between these, the concerns of the EJ community in these disadvantaged areas and potentially, so maybe a cut not going to the government, but a cut going to help those communities, is that something that potentially has legs? Or?
Yeah, again, I go back to, forest offsets are intrinsically good. If you want to encourage that good, you make it easier for smaller people to participate. And if you want it to work in California, I think that the best rule change they could make is to make it work for smaller landowners. The smaller the landowner, the more easily you can direct the funding to find people that are in these more rural and disadvantaged communities. Offset projects, they promote clean water, which is very important. You're putting more money in the land. You have more focus on the things that are happening in the forest that clean air, clean water, all those things are wholesome and good. Wildlife, habitat, promotion of tourism, fishing, healthy fisheries, all those things are great for this state. So one of the ways to make that happen is to increase the opportunity, not decrease the opportunity for landowners here.
And so does that mean, I guess if you were looking at the financials, there's kind of the price of offsets now and then the marginal abatement curve for some of the harder to get, the higher fruit on the tree. And actually someone I was speaking to at lunch proposed that maybe some of the auction money be used to fund that gap and make those projects that you're talking about more viable, and therefore, bringing more offsets, bringing more communities in. Is that something you think could work?
I absolutely think that could work, because one of the things that's kind of an issue here is that you have development rights, people that want to go out and buy forest land, subdivide it, and use it for kingdom lots or large recreation lots. And then you have people that are trying to keep forest intact. The more intact the forest, the better they'll sequester carbon dioxide for climate change. One of the issues here is that you have carbon, which affects biomass, and then you have easements, which are there to control development. They don't work very well together at all right now. So I think that the state looking at how to make carbon and easements work better together, and then create more funding for easements, because the more money that's there for easements, the more carbon projects there are going to be, and the more carbon dioxide is going to be sequestered in the state.
Okay. So I think we've probably all got our offset fill now. So turning back to linking, I guess we should talk about, so obviously Ontario and WCI is the main, the one that everyone's expecting, but there are others that are potentially on the horizon. So Mexico they're running a simulation now for an ETS, and they could potentially link. And other state partners, including Oregon, Washington State. So, Jackie, do you want to talk to us about the impacts on Ontario linking to the WCI?
Yeah, sure. So I can give you a little bit of sense of our modeling. I think, as many people know and have heard earlier today, that Ontario is looking to link with the program starting in 2018. They have a pretty ambitious 2020 goal and 2030 goal as well, and with the program centered around that, they've got a constraining supply over the next few years. In addition, that comes with emissions. They've already done a lot in terms of reducing emissions. From 1999 through 2014, their emissions were declining. They've phased out coal. They've made some cuts in the industrial sector, a number of different things. And so looking forward, our forecasts suggest that emissions are going to grow over time. I think that's generally what the market believes as well. And I would say our forecast is probably a bit more conservative than most people's in that sense. But along with economic and population growth and growing emissions over time and a constraining cap, we believe the Ontario market's going to be pretty short pretty quickly. So the first year of annual shortage would be 2019 in our forecast, and then the market's overall short in 2020. So coming into the California market potentially in 2018 here, we believe they're going to be pretty heavily net buyers pretty quickly of California allowances, and ultimately, I'll kind of just jump to the punchline here. In our price forecast, if you look out to 2030 without giving away too much here, with Ontario in the mix, our base case forecast is $20 higher, just because of the way that they're structuring the program and their ambitious goals moving forward.
Okay, and I'm slightly concerned that Chris is being uncharacteristically quiet. I wonder if you want to talk to us about Oregon and Washington and what's going on there.
I can give you the thumbnail sketch as I understand it. I mean, I think the short answer is there's nothing imminent likely to pass and create a linking opportunity. There's 2 bills in the Oregon legislature. One of them is a cap and trade with an explicit encouragement of linkage to from Oregon to California. Another is more of a carbon tax approach. And I know there are some people working for that. I think the sort of the play, so to speak, is to get all the policy details agreed to by the end of the session, and then there's a short session in February next year in Oregon where they're going to try to pass it. So, but honestly, it didn't seem like much more than a 50-50 kind of chance. And then, in Washington State, we had that ballot initiative that failed, sort of split the environmental community around how revenue was going to be treated. And, Jay Inslee, the governor, it's one of his top priorities, but, kind of perversely, because the Republicans are in charge of the Senate, that makes them more inclined to dig in their heels because it's such a priority for Inslee. So I don't think there's a clear path in Washington right now, as much as there are folks working for that.
Mm-hmm. Okay. And no discussion about North American markets would be complete without talking about one of the first ones, which is Reggie. So they're in the midst of a program review that seems to not have any end. So there was actually a webinar today about that as well. But I was wondering if Andre wants to give us a quick word about Reggie.
Yeah, I mean, Reggie is interesting in that, they had a very, they seem to be on a very aggressive timeline when CUP was there because they wanted to sort of submit their implementation plan. And now that CUP has sort of, been shot by Trump, I think that speed has slowed down quite a bit, to your point. I don't think they're in any rush at all. You'd hope they get there by the end of the year. But bear in mind, if they get there by the end of the year, you then have a full year for all the legislatures and regulatory bodies to accept it. And so really the earliest that, Reggie can sort of start to, have any of those changes implemented would be 19, most likely more like 20. So I think Reggie's sort of on a slow burn. The things that might change it is, does Massachusetts and New York try to push linkage? Do they try and push, do they look at what's going on in California and say, hey, they're higher priced, they seem to be doing more stuff, why aren't we doing stuff? And there's a little bit of that. But back to the linkage question or Reggie, I think the biggest thing that California can do is make sure that you don't falter. California, if you slip up, if the bill doesn't get extended, the program doesn't get extended, if we get stuff in it that makes it unworkable, if we kill offsets, if we do different things that make this program too expensive or too difficult to adopt or for other jurisdictions to link to, then you lose that sort of shining light that California has been up till now. And so I think that's the biggest thing that is going to feed into all these other markets, whether it be linkage or Reggie. I mean, success here means success probably in Reggie, and it means other states looking at California. Failure here means a lot of other places going, well, look, I mean, it's not working. So everybody's watching what California's doing, and I think the point that I would make to stakeholders is, get out to the legislature, get out to the people who are making the decisions and tell them that people are watching and that what they do is not only going to affect California, it's going to affect, in this Trump era where you've got a politician who can do the nutsiest stuff on the planet, you need subnational governments to do something and not trip up, because if they trip up, I guarantee you somebody like that's going to take advantage of it, and it's a horrible outcome.
So I guess to borrow a Star Wars analogy, California is kind of the Obi-Wan Kenobi to the rest of the continent's Princess Leia, and it's our only hope.
Does that make Trump?
I know that was a bit of a long walk to get there, but so how much time do we have left? 10.
We have
okay.
10 minutes left.
It's a lot. So I thought.
Kidding. Back to offsets? No, I'm kidding.
We could. I've got other offset questions. I'm keen to open it up to the floor as well. Maybe if anyone has any questions or comments. No? Well, I guess that's a good sign. So
I saw an arm over there.
Oh, was there?
It's
Sorry,
you're shining.
I'm blinded
it's hard
by
to
the
see
light.
you, but. Chris did a good analysis on that I read sort of 2 or 3 weeks ago, and if I can paraphrase Chris, and Chris can probably comment after it, essentially you kind of backward solve so that sometime in 19, the auctions really need to, essentially you could only fail all of 20 and maybe 19 in a ultra pessimistic view. So the reality is, at some point you do need to clear these auctions again, and I'd agree. So, essentially the government's got control of enough allowances and they're selling them that if they don't sell enough, eventually the auctions have to succeed and have to come back to a full subscription.
Right. No, that's a good way to put it. I would say, another way to look at it is just the average sales have to be around 75%, apart from whatever variation auction to auction. So the levels we've seen over the last 5 just wouldn't put people into compliance. So.
Yeah, and I was going to touch on that point. So if you're thinking more short-term in nature, we don't have enough allowances in the market right now, CP2 allowances or even CP1 allowances, to comply with the obligation that's going to be due in November 1st, 2018. So you do need to see a number of allowances selling at these next 3 auctions. There's not a ton of wiggle room in there. I think you said it was 75 to 80%, if that holds true for that. And then, once you see those 2 consecutive auctions clear, you can get more volume that's returning these V16s.
Yep.
Which also poses a big question for the market and how those return. But yes, again, you can start to rebuild that bank. Do you see another similar situation in the future where the bank is $100 million again? There's some other legal, legislative uncertainty, regulatory uncertainty. But yes, right now the market is pretty tight. And without offsets, it's very, very, very tight. If not,
I was going to ask, do you factor in kind of full offset usage by then?
By 28, so our assumptions aren't that there's full offset usage in this compliance period. So there have to be the supply to meet that. If you're gonna, I guess the more unsold allowances there are in these auctions, the more offsets you need. I don't know if that offsets are gonna be able to totally fulfill that demand now. Yeah.
Offsets make a big difference in our modeling in the back end.
Yes,
So,
they do.
I mean, they're relevant now, and they help a little bit now. If this program goes through 2030 and you don't have offsets, you're a lot higher priced.
Exactly. Yeah, we did some analysis on that actually. And yeah, I guess without giving away too much, but there was a difference. So we held all other assumptions constant through 2020, and then in the post-2020 program, we took 0% offset usage and 8% offset usage, and there's a price discrepancy of $15, which might not immediately sound like a lot, but that's roughly 20-25% of the price. So in my opinion, that makes offsets very important, as you were saying, Sean, that they're there as that flexible compliance mechanism. Out in those later years, especially as the market gets shorter and shorter and eventually short.
This goes to another point about the extension of the program. If we don't have clarity on post-2020 soon, there aren't going to be a whole lot of offsets originated over the next 24 months. We already see this now. Landowners say, why am I going to sign up for this program if I'm only going to get paid for the next 3 years? When you're making a 100-year decision about logging up your land, it just doesn't work out. So until this 2020 extension is resolved, we're not going to be originating new offset projects. It just isn't possible because nobody has the clarity. It's a 2-year lead time minimum to get a project through. Then the contracting on the front end. So easily from the day we start talking to a landowner until we have issued offsets, 3 years goes by.
Yeah.
So if we're not doing anything on that this year, and maybe not, depending on when we hear this, maybe not next year. I mean, we've got a huge lack of supply for CP3.
Yeah, and I think the other thing, we didn't really talk about the bimodal nature of the market because we don't have time to, but we didn't want to argue that. But I think the important thing to remember is that, again, it is crucial that it happens this year because the longer that these things are put off, the more it affects supply, the more it affects demand, you just start to run into real problems. And it's kind of like the seeds to a market crisis in terms of price spikes are laid by years and years of uncertainty and underinvestment, both in emission reduction technologies and offsets. And so, the reality is the time for action is this year. It can't be next year. Next year is way too late. And if you're talking to anybody, tell them don't wait till next year. It's bad. Very, very bad.
Do we have any other questions? Yeah, over there.
I think it's probably 70% chance that it gets through this year because it has to, and because the governor put his foot down. But it's gonna come down to the governor. So one of the things that I was looking for today when he spoke was that he said, "Look, I'm going to spend the next couple of weeks working on that." He kind of laid that groundwork in January of this budget, and he now needs to deliver. The people in the assembly are not going to do it. they're bickering and fighting, and they've got all these little fiefdoms, and so I like them. They're all nice people, but they won't do it. So the governor, if he does not get involved, this won't happen. So I think the person you need to watch is the governor. And if the governor gets involved in the next 4 to 6 weeks and really actively pushes that agenda, it'll get done. If he doesn't, we could be in real trouble.
What about the Senate?
Senate is smartly waiting to see what happens in the Assembly and if the governor steps up. So it was kind of interesting. I don't know if people watched SB1, but SB1 was very interesting because it was a little bit of a Thelma and Louise sort of situation. They were waiting right till the end, and if you walked around the building that day, you talk to people in the Senate, and they'd be like, well, we're going to vote on it only when we're sure they're going to vote on it. And then you go over to the Assembly, and they're like, well, we're not voting on it until we're sure they're going to vote on it. And I was like, do you guys want to hold hands as you go across the cliff? But nobody wants to be the one to step out and say, we authorize a tax increase or we authorize cap and trade. So both the Senate and the Assembly are sort of waiting for the other side to grow up and figure out how to do it. And look, the adult in the room, the oldest guy in the room is the governor. He's got to get involved and he's got to fix it.
The guy
So
who was Googling cap and trade on the way over here. He said.
It's him.
Wikipedia.
Yeah. I'm glad he Googled cap and trade because he needs to fix it. So.
Sorry, I think there was another question over here somewhere. Any others? Yeah.
Actually, I was
Yes.
Yes. 2018 through 2020. Yeah, we're in the middle of CP2 right now.
The end.
The end.
Yeah.
Well, yes, almost.
Close.
Our market loves acronyms.
Yeah,
Anything
we do.
else? Any other questions? No. Do you guys have
Oh,
any?
there's one other.
Oh, sorry. Yeah.
A great question. So I think that a lot of analysts just assume that's the case. We don't see it. I mean, offsets aren't that strongly linked. When you look at offset demand, it's actually much more, it follows the cyclical nature of compliance.
Yep.
People tend to buy a lot of offsets at the end of the compliance period. So you don't see it on a day-to-day basis. Offsets trade at blank discount to allowances. That's not really the case. It's all supply and demand based. Offsets, the trend going forward in offsets, so there are going to be fewer bigger projects, which means much spottier, issuances that come onto the market once and then there's nothing. And then there'll be huge issuance on the market once and then nothing. And then the buyers, the people buying golden, are all going to buy at the end. So I wouldn't be surprised if we see the same, offsets go like this and then they spike. And offsets go like this and then they spike and they come back down. I mean, that's what we've seen. It's probably what we will see.
Yeah, offsets are much more sticky in price. So even as discussed earlier, when CCAs went up 60 cents, offsets would go up 20 cents. So they just don't move as quickly up. They generally don't move as quickly down as well. But
All right. So we're out of time. I'd like to thank the panel for a riveting discussion. And if anyone else has questions,